Welcome back to the deep dive. You know how this works. You bring us the source material, the corporate histories, the financial reports, all of it, and we're here to give you the essential knowledge.
And today, we are really getting into a giant company you see everywhere, but whose story is, well, it's one of the most fascinating in American retail.
We are talking about AutoZone.
Exactly. And our mission for you, the learner, is to unpack this company's entire 46-year journey. I mean, it went from what was basically a side project in a grocery business.
A grocery business.
Yeah, a grocery business, to becoming the single largest automotive parts retailer in the United States. We're going to get under the hood, so to speak.
And the scale we're talking about is, frankly, hard to wrap your head around. Looking at the metrics for 2025, this isn't just a chain of stores.
No, it's a global machine. We're talking 7,657 locations. And that's not just in the U.S.
Right. It's Mexico, Puerto Rico.
Brazil, the U.S. Virgin Islands. It's a huge footprint. And to run that, you need an army. It's about 130,000 employees worldwide.
That's the size of a decent-sized city. Just incredible. And the revenue reflects that dominance.
It absolutely does.
Yeah.
Annual revenue is hitting U.S. $18.9 billion.
Wow.
And the other numbers, they look pretty solid on the surface. Operating income is about $3.6 billion. Net income comes in at a healthy $2.5 billion.
Total assets are up there, too, over $19.4 billion.
Right. So you see all this and you think, okay, this company's a fortress.
But there's always a but. And this is the detail that should make anyone looking at their financials pause. It's the total equity figure.
It's not just a little strange. It's deeply negative. As of August 2025, AutoZone's total equity is negative $3.4 billion.
Okay, so let's stop there. Because for most people, that sounds impossible. If you're making almost $19 billion a year, how can your equity be negative? Doesn't that mean you're, broke?
That's the key question. And it points to a really aggressive corporate finance strategy, not a failing business. Negative equity does not mean they can't pay their bills.
So what does it mean?
It means they have been buying back their own stock on a massive, massive scale. And they've been doing it for decades, mostly financed with debt.
So they're borrowing money to buy their own shares off the market. How does that make your equity negative?
So think about the balance sheet. When you take on debt, your liabilities go up. Then you use that cash to buy back stock. When those shares are retired, you have to reduce your shareholder equity.
Okay.
And if you do that aggressively enough, for long enough, you can literally wipe out all your positive equity and push the number into the red.
So the $19.4 billion in assets is just completely overshadowed by the liabilities, which is all this debt they've taken on. Why do it? What's the upside to such a risky-sounding strategy?
It's all about one magic number, earnings per share, or EPS.
Right.
By reducing the number of shares out there, you're dividing your net income by a much smaller number. So your EPS figure shoots up, which Wall Street absolutely loves. It drives the stock price higher.
It's financial engineering, really. You're prioritizing shareholder returns through a higher stock price over, say, paying down your debt or reinvesting that money.
Exactly. It is a high-stakes game that has defined AutoZone's financial story for years. It's a very aggressive playbook. And that negative $3.4 billion figure, it's the key.
So this whole story is really about two engines running at once.
A phenomenal way to put it. One engine is the physical, logistical dominance in retail. The other is this highly leveraged, debt-fueled financial model. That's the lens for everything that follows.
A perfect place to start. So let's rewind the clock and go back to where this giant began. And it's not where you'd expect. The story of AutoZone doesn't start with a gearhead in a garage. It starts with, of all things, a wholesale grocer.
Yeah, it's a truly bizarre origin story for a company like this. The founder was J.R. Pitt Hyde III. His family's business was Malone and Hyde, a big, successful wholesale grocer out of Memphis.
So they're moving food around, basically. Canned goods, produce.
Exactly. Traditional distribution, it was the family business.
But Hyde got an idea from a completely different industry, right? This is where the story gets interesting.
It is. In 1978, he joined the board of directors at Walmart.
Okay, so he's getting a front row seat to Sam Walton's retail revolution.
A front row seat. He's seeing their focus on low prices, on super efficient supply chains, and he has this realization. He sees that the auto parts world has similar logistics to groceries.
But it's a total mess from a retail perspective.
A total mess. It was completely fragmented, disorganized. It was just ripe for disruption.
And he famously admitted he didn't really know much about cars.
And that was his secret weapon. If he'd been a mechanic, he probably would have just built another grimy parts store. But because he wasn't, He looked at it purely as a retail problem.
How do you sell this stuff to a normal person?
Exactly. So the first store, which was called Auto Shack back then, opened in Forest City, Arkansas, July 4th, 1979.
And what made it so different from the competition?
Oh, it was night and day. The typical parts store back then was, dark, cluttered, and run by some gruff guy who made you feel stupid for not knowing what a gasket was.
I think we've all been in a store like that.
Right. So Hyde's idea was built on three pillars that were the complete opposite of that.
Okay, what were they?
First, good customer service, actually helpful, friendly staff. Second, everyday low prices, which was straight from the Walmart playbook, no haggling, no crazy markups.
And the third one feels like the most important.
It was a clean, well-designed, brightly lit store. He wanted it to be a place where anyone, a hardcore DIYer or, a woman who had never changed her own oil, would feel comfortable walking in.
He was basically democratizing car repair, taking away the fear factor.
And it took off. That first day, they only did about $300 in sales, but the model was solid. By 1980, they had 8 stores.
And it just kept accelerating from there.
It really did. 20 stores by 1981, and then just 4 years in, by 1983, they opened their 100th store down at Waslaco, Texas.
That's explosive growth. And it must have required some serious logistical thinking right from the start.
Absolutely. They knew the biggest problem was having the right part at the right time. If you don't have it, the customer walks. So in 1981, they opened their first express parts service warehouse in Memphis.
And what was that for?
It was for all the weird, slow-moving parts, the stuff you don't want clogging up a small retail store. They could just shuttle parts from that warehouse to the local stores really quickly.
So they were already building the early version of their hub-and-spoke model?
They were.
Yeah.
And in 1986, they launched their own private label, Duralast. They started with alternators and starters.
Which is a brilliant move. Control the quality, control the supply, and most importantly...
Control the profit margin.
Exactly. But the real stroke of genius from that era, I think, was the Loan-A-Tool program.
Oh, Loan-A-Tool was it was perfect. It started in '86, too. It solved the biggest problem for the home mechanic. You need a special tool that costs $100, but you're only going to use it once.
So they just let you borrow it.
You put down a deposit, you use the tool, you bring it back, you get your money back. It made them an indispensable partner. You borrow the tool from them, so of course you're going to buy the parts from them too. It was a complete ecosystem.
And while all this retail success is happening, the company's ownership structure is changing in a big way.
Yeah, the growth got the attention of Wall Street. In 1984, the parent company, Malone and Hyde, was part of a big management buyout. Pitt Hyde was involved, Peter Formanek, who became president.
And the big one, Kohlberg Kravis Roberts and Company, KKR.
And when KKR shows up, you know the game has changed. This isn't a family business anymore. It's about aggressive, leveraged growth.
They took the company private, and by 1986, Auto Shack was spun off as its own independent company.
Right, but just as they get their freedom, they hit a legal wall that nobody saw coming.
The lawsuit from Radio Shack.
The famous lawsuit. Radio Shack sued them in 1986 for trademark infringement. They argued that the name Auto Shack was just too similar and would confuse customers.
And Radio Shack won. It's crazy to think that's the only reason we call it AutoZone.
It is. They lost on appeal, and in 1987 they had to change the name. The first official AutoZone store opened in Enid, Oklahoma. But they were smart about it. They used this forced change as a chance to upgrade their whole image.
How so?
At the exact same time as the rebranding, they launched their brand new electronic catalog system.
So they're getting rid of the old paper manuals.
Totally. Now the staff could look up parts, check warranties, see inventory across the whole network, all on a computer screen. It wasn't just a new name. It was a new, modern, tech-focused company ready for the 90s. So the 1990s, this was really the decade of just massive, massive scaling. They had the model down, and now it's time to pour fuel on the fire.
And that fuel came from their IPO. In 1991, Hyde and KKR took the company public, New York Stock Exchange, ticker AZO.
And that IPO cash went right into building out the infrastructure. By 1994, sales hit $1.5 billion, and they were already investing in pretty advanced tech for the time.
They started using satellites. For a parts store, that sounds like something out of a spy movie in the mid-90s.
It does, but it was essential for their model. Their entire advantage was built on centralized control. Satellites meant they could push real-time pricing and inventory data to every single store instantly. It kept the whole network in sync.
And the network just kept growing. Their 1,000th store opened in '95 in Louisville, and they kept building out that Duralast brand, right?
Yep. Dureless Gold batteries came out that same year. But the really big move, the one that showed where their head was at, came in 1996. They paid $56 million to buy a company called AllData.
This is so important. All data doesn't sell spark plugs. It sold information.
It sold the brains of the operation. AllData was a software company that provided all the technical info mechanics need. Diagnostic codes, repair manuals, wiring diagrams, all of it.
So by buying them, AutoZone wasn't just a parts store for DIYers anymore. They became a critical resource for professional mechanics.
Instantly. It gave them huge credibility with the pro market, which is where the real high-volume sales are.
Pitt Hyde steps down as CEO in 97, but the company's strategy just gets more aggressive. 1998 was basically a feeding frenzy.
It was a massive shopping spree. They bought 4 different companies that year. Auto Palace, Truck Pro, but the huge ones were 560 Chief Auto Parts stores and another 100 express stores they bought from Pep Boys.
You buy 660 stores from your competitors in 1 year. That's how you dominate a market.
It's a land grab. You just absorb the competition. And they capped off the decade by going international. The first store in Mexico opened in December of '98.
And the final seal of approval, they landed on the Fortune 500 list in 1999. They were officially in the big leagues.
So as we move into the 2000s, the focus really shifts. It's less about buying up stores and more about, building the digital backbone to run this massive empire efficiently.
And that starts with AutoZone in Chihuahua, Mexico in 2000.
Right, which was way more than a call center. They centralized huge parts of the company there. Finance, IT, merchandising, customer service. It was all about keeping costs low and control high.
But the true strategic masterstroke of that decade, the thing that really built their competitive moat, was the new distribution model they launched in 2002.
The hub, feeder, and satellite model. This was just a work of logistical genius. The goal was simple, but brilliant,
Increase the number of parts you can get to a customer quickly.
while decreasing how much money you have tied up in inventory in every single store.
So break that down. How does the three-tier system work?
Okay, so your local AutoZone, that's a satellite store.
Hmm.
It has the basics, the stuff that sells every day. Oil, wipers, common brake pads.
Okay.
Nearby, there's a larger hub store. And that store is packed. It has a much deeper inventory, the weird parts, the specialty tools. The hub makes multiple deliveries to its satellite stores every single day.
So if I go to my local store for a part for my, weird old car, they don't have it. Instead of saying, come back next week.
They say, we can have that here for you in 2 hours. It captures sales that would otherwise be lost. And financially, it moves all that expensive, slow-moving inventory out of pricey retail space and into a centralized, cheaper location. It's brilliant.
And that superior logistics network made them a powerful partner. Midas outsourced their entire parts distribution to them in 2003.
That says it all. A huge national service chain realized AutoZone could do logistics better and cheaper than they could do it themselves.
And the growth continued. Puerto Rico in 2005, the 4,000th store in 2007. And they upgraded their tech again that year.
Yeah, ZNet was introduced. This was the next generation of their electronic catalog. It integrated everything parts, repair guides, inventory into one system for the employees.
So then we get into the 2010s, and they're really embracing the digital omnichannel world. Buy online, pick up in store in 2010, which was pretty early for that.
A mobile app, too.
Huh.
And they finally planted a flag in all 50 states, opening their 5,000th store in Wasilla, Alaska in 2012.
They also expanded to South America that year, into Brazil.
They did. And they also experimented a bit with some acquisitions, buying an online retailer called AutoAnything.com and a specialty importer called IMC.
But they ended up selling both of those off just a few years later, by 2018. What does that tell you?
It tells me they decided to double down on what they do best. The online-only model, the specialty import supply chain.
Okay.
It was probably too complex or didn't fit their high-efficiency model, so they cut them loose and focused on their physical stores.
And that brings us to the next evolution, the mega hub strategy.
This is where they just leave competitors in the dust. A mega hub is basically a hub store on steroids. It's a huge distribution center, but it's placed right inside a dense city market. It might have 3 times the inventory of a normal hub, up to 100,000 different parts.
And the goal here is all about speed for the professional mechanics.
100%. The pro market is their cash cow. A mechanic can't wait 3 hours for a part, they need it in 30 minutes. The mega hubs make that possible. They can flood a market with parts almost instantly.
And they built these out at an incredible pace.
An incredible pace. They had 28 mega hubs in 2019. By 2021, that was up to 58. By 2024, the plan was for over 100. It's an all-out assault on the market. based on speed and availability.
They also adapted to the times, adding curbside pickup during the pandemic in 2020, though they also had a couple of stores unfortunately destroyed by arson during the protests that year.
Right. And finally, the decade ends with a very smooth, planned leadership change. William Rhodes, the longtime CEO, steps down in 2024, handing the reins to Philip Daniel. A very orderly transition.
All right, so we've traced the growth. Let's look at the core of the company itself, the infrastructure, the brands, and one really wild fact about their headquarters.
Yeah, the headquarters. The J.R. Hyde, the third store support center in downtown Memphis. It's a big building, 270,000 square feet, over 1,200 people working there, running the whole global show.
But it has a very special feature built to withstand a very specific and terrifying threat.
Right. Most people don't know this, but Memphis is very close to the New Madrid seismic zone. It's a massive fault line that could produce a huge earthquake.
So what did AutoZone do?
They spent nearly $1 million, $950,000, installing a special base isolation system under the entire building.
So the building is essentially on giant shock absorbers.
Exactly. It allows the ground to shake violently underneath it while the building itself stays relatively still. It's engineered to survive a 9.0 magnitude earthquake. It is the most earthquake-resistant building in Memphis.
That's an incredible investment, and it says everything about their mindset. Control and continuity no matter what.
It does, and that desire for absolute control is why they have 0 franchises.
That's a huge point. All 7,657 stores are owned by the corporation.
It's fundamental to their strategy. You can't run the mega hub system with franchisees. You need to be able to dictate inventory, pricing, and logistics from the top down instantly. Franchises would just get in the way.
Total control. And that extends to their product line with their private label brands.
Duralast is the king. It's their flagship. They've built that brand meticulously since 1986 to cover everything from batteries to tools.
And it's a gold mine for them.
A total gold mine. The profit margins on a Duralast part are way, way higher than on a national brand part they have to buy from a third party.
And for the budget-conscious customer.
They have the Valleycraft brand. That's their entry-level line, especially for things like car batteries. It lets them compete on price at the low end while they make their real money on the Duralast stuff. It's a classic good, better, best strategy.
Outside of the stores, they've also been very smart about building their brand through sponsorships.
Very strategic sponsorships. They've had a deal with NASCAR since 2004. That's a perfect demographic for them.
And Bellator MMA, the mixed martial arts promotion.
Yep. Connecting the brand with toughness, performance, reliability. It's smart marketing. And in their hometown of Memphis, they're a huge community presence.
They have the naming rights to the baseball stadium.
And, of course, the AutoZone Liberty Bowl. That's their signature event. It's not just an ad. It connects them to a big college football game and lets them do a lot of charity work.
Right, like their big donations to St. Jude Children's Research Hospital. It gives a parts retailer a much softer, more positive public image.
It's all part of building a brand that feels like a pillar of the community, not just a faceless corporation.
Ah.
So we've built this picture of AutoZone as
Right.
this hyper-efficient, technologically advanced machine. But when you pursue that level of growth and efficiency so aggressively, it creates friction.
Right. And that friction shows up in the legal record. The source material is full of these massive lawsuits and settlements that tell a very different story about the company.
It's a huge contradiction. You have a company that will spend $1 million to earthquake-proof its headquarters.
But then gets hit with an $11 million fine for illegally dumping hazardous waste.
Exactly.
Huh.
Let's start with those environmental issues. There was a lawsuit in California back in 2005, settled for $1.5 million. But that was just the start.
The 2019 settlement was the big one.
It was $11 million to the state of California to resolve allegations that they had illegally disposed of millions of items.
Millions. We're talking used motor oil, antifreeze, batteries, aerosol cans, just dumped in regular landfills all across the state.
And that's not a mistake. That's not one store manager messing up.
Yeah.
That suggests a systemic, company-wide failure to follow the law.
It points to a culture where maybe the pressure to be fast and cheap outweighs the pressure to, handle toxic waste properly.
That's the implication. Proper disposal is slow and expensive. And when the whole corporate mandate is about maximizing that EPS number, those costs become a target. It's a classic case of short-term savings leading to long-term pain.
And the problems go beyond just environmental issues. There have been some really high-profile lawsuits about the workplace culture.
These are tough to read about, but they're critical to understanding the company. The biggest one was the 2014 gender discrimination case.
This was the case where a woman was promoted, alleged she was treated poorly by male colleagues, and then after she became pregnant, was pressured to step down, demoted, and eventually fired.
The jury's reaction was a thunderclap. They awarded her $185 million in punitive damages.
An astronomical number.
Now, everyone knew that number would be reduced on appeal. There are legal caps on those things. But the sheer size of the initial verdict was the jury sending a massive signal about how they viewed the company's conduct in that case.
It's a huge warning shot to the entire organization.
And it wasn't a one-off. In 2018, there was another suit from a woman in Georgia who said she was fired after a customer went on a racist tirade at her. And she alleged her manager's response was basically to tell her to suck it up.
Which raises all sorts of questions about whether frontline employees are being supported and protected by management.
And then there's the public safety side. In 2018, they paid out $3.3 million to settle a lawsuit from a crash in 2016.
This was where an AutoZone truck rear-ended a stalled car, and 3 people were killed.
And the lawsuit wasn't just about the crash itself. It specifically alleged that AutoZone had been negligent in how it trained its truck drivers.
So if you connect all these dots, the environmental dumping, the discrimination cases, the driver training, a pattern starts to emerge.
It does. It looks like a company whose logistical engine is moving so fast with such an intense focus on cost-cutting and efficiency that it might be systematically undervaluing these essential but costly things like compliance, training, and a supportive workplace culture. And that leads to these huge recurring legal bills.
And that brings our deep dive on AutoZone to a close. We've seen it all: the logistical genius, the aggressive finance, and the significant corporate friction that comes with it.
To really sum up their success, you have to go back to Pitt Hyde's original vision. He took the Walmart model and applied it to a messy industry. He made it clean, friendly, and accessible. And the Loan and Tool program was just a masterstroke.
Then you layer on top of that their obsession with technology and information. From that first electronic catalog all the way through buying all data and building ZNet, they knew knowledge was power.
And finally, the ultimate competitive advantage, that fully owned, hyper-optimized distribution network. The Mega Hub system is something their rivals just can't easily replicate. It's their moat.
The big aha moments for me were just the stark contrasts. The grocery store origin. The fact that losing a lawsuit to Radio Shack actually pushed them forward technologically. And of course, the earthquake-proof headquarters.
But for me, the biggest takeaway is that financial paradox. The $18.9 billion revenue giant with negative $3.4 billion in equity. That negative number tells you almost everything you need to know about their core financial strategy.
A strategy focused relentlessly on stock buybacks and boosting that share price.
And the strain from that relentless focus seems to show up in those big legal fights we just talked about. The $11 million environmental fine, the massive discrimination verdicts. It's the other side of the coin.
Which leads us to our final thought for you, the learner, as you process all this.
Given AutoZone's undeniable brilliance in logistics, in technology, and in customer service, what does this repeating pattern of 9-figure verdicts and 8-figure settlements for things like waste disposal and labor disputes, what does that tell you about the internal priorities of a company that is growing so explosively and so aggressively?
Can a company become so focused on external efficiency and the customer experience that it allows its internal standards for compliance and even basic human decency to slip? And what happens long-term when you let that imbalance continue?
It's a critical question for any business at that scale.
Something to think about. Thanks for joining us for the deep dive. We'll see you next time.